some renters may be mortgage ready and not know it. And here's how to tell. So this is also from CNBC. These were kind of published in the same little window, which is why I put them kind of back to back for us today. Among those who did not own their home, roughly 7.9 million families were considered income mortgage ready, Zillow found in a study. Now, that's a lot of people. That's nearly 8 million people. You could cut that in half and tell me, Andy, it's 4 million, and I'm still going, wow. Well, now we have an even bigger inventory problem, and we have a demand issue that's going to keep prices higher. So I was surprised that it was this many people, honestly.
Of course.
Given the nature of what we deal with when it comes to debt-to-income ratios and that kind of thing, I was honestly surprised it was that many people. How can we get some of those people from off the fence from paying rent that is the equivalent of a mortgage into a mortgage?
Yeah. I mean, it makes perfect sense. A lot of times we just don't go out there and get approved because we think it's a tedious process or it's just very difficult, right? Just kind of like when I got in the industry of mortgages, I'm like, I'm kind of not the smartest person. I can do mortgages. It's all about math here. Like, what does it take? Do I need a freaking PhD for it? And then, right? Like, I just didn't know what I didn't know.
You're not giving yourself enough credit. Okay, just aside from the whole conversation we're having, you got to give yourself more credit than that.
No, but you see what I'm saying? It's just like for me, I thought it was difficult until I tried it, and then like, oh my God.
Well, so
here's the process.
There's a segue. I'm sorry, Brian. I'm going to cut you off. There's a segue because you're saying that about your relation to joining the mortgage industry, and one of the points of the article is that having a working familiarity of crucial facts actually helps. So, in the same way, those people who are mortgage ready and renting, being aware of and having familiarity of the critical facts and crucial facts, knowing what it takes to buy, that might help you out as well. So, well, same for me. same.
I think it's more of like a personal belief that they don't think that they can, buy a house, but in reality, it's like they never really tried, or no one ever really told them what to base it off, or they don't have the right information to take a confident decision. And I think that's the biggest thing. But at the same time, how do you get them to want to, entice them to want to learn about that process? Well, if you're seeing rents go up, and you're okay with that, well then maybe that's a light bulb that said, hey, maybe I should look into my housing situation. If rent keeps going up, is my income going to keep going up? Like, at what point do I, say, hey, maybe I should look into buying a house, having something more stable, because as you know, rent's just going to continue to go up, and when it does come down, it comes down for a little bit, only to go raise it right back up again. So I think it's more of, like, hey, I can't because, either, I think it's too hard, but they don't really take the time to actually just ask the right questions. Which I feel would be the first step that, you could get started with.
It's so true. I mean, a lot of times we think, okay, well, I'm renting, I'm very comfortable. And sometimes we do have those landlords that they just don't increase the rent on you.
Yeah.
I mean, you've been there for 5-10 years and they're not really increasing anything. But then you have the other ones that do run their homes as a business, and they do have, increase the 5 or 10%, whatever is legal in your area. I know that Biden's passing a new law with that, to have rent control.
Yeah.
Because these things are happening, right? And so when we're talking with our first-time home buyers, some of the questions were like, well, Brian, what makes you want to purchase a home? They're like, I'm tired of renting.
Yeah.
Oh, okay, so you're tired of renting. What is it that you're tired of? Well, my rent keeps going up. Yeah. And it's going up now another $300, so I feel like I might as well just own a home. Oh, okay, good. Yeah. That's a good reason, right?
Yeah.
Because here's one of the things, guys. When you buy a home, here's the difference. When you buy in a home, you're locking in yourself for a 30-year fix. That means your payment's not going to change for 30 years. Despite of inflation or anything, you're in a fix for 30 years. Unlike a rent, every year it could go up anywhere from 5 to 10%.
Yeah.
So, and the cool thing with mortgages, we already understand, yes, right now affordability is very difficult. But if you are able to afford and you could get in there with the years to come, and the rates go down, you can actually tell yourself, hey, I'm actually making a little more money because now I'm paying less, and I get to put that in my pocket.
Yeah, and I want to draw a connection to the previous article that we talked about today when it talked about homes that are $1 million and above, and those in the $250,000 range, because I think there's a massive opportunity for people, for these 7.9 million people, some of which do not live in most of which don't live in California, that you actually might be able to get into a house, just mathematically speaking. So it becomes mostly just a choice, not even whether you can or can't. It's just, do I want to or not want to? So real quick, you guys are chatting, and I'm looking, basically there's a 2-to-1 ratio of these homes that are these buyers that are mortgage ready compared to the seasonally annualized homes for sale. So in the previous article, they're like, it's 3.89 million homes seasonally adjusted. Well, there's 7.9 million families that are mortgage ready, which is a 2-to-1 ratio.
2-to-1.
Now, we were talking about demand and that keeping up prices and all that, but this is where I think there's maybe a pocket of opportunity for people across the country where if you are in an area and your rent is $1,500 a month, $1,800 a month, and there's a house down the street for $200,000 or $250,000, you should honestly seriously start thinking about whether or not that's a place you should be buying or not. Because even if you are an SFR and you're renting it for $1,800, your mortgage might be the equivalent in that space. So this isn't me selling you into being a homeowner. I'm saying, look, all I'm saying is, I'm not saying come sign the dotted line. I'm saying take a minute and ask the question. You might be in a really good situation.
Exactly. That's great advice.
Yeah.
Very, very true.
Two things here that they want everyone who is income mortgage ready to do. Number one would be checking your credit, which we, of course, we're behind. And I think there's the myth that like, oh, checking your credit is going to harm your credit. Listen, the amount that your credit gets checked is the smallest weight of factors that weigh into your score. So just so you know, we covered this on the previous show, 65% of your credit score is generated by your credit history and your current balance relative to your limit. Those two things together are 65% of your score. Getting your credit checked is the smallest part of what makes your score. So getting your credit checked and then understanding debt to income ratio.
You know, a lot of people are just so fearful, like, oh, it's a hard pull. I had a client, you know, as a matter of fact, today say like, oh, I'm concerned you're going to pull my credit. It's a hard pull. And I go, yes, it's not going to be impactful like that. If your credit's excellent, it shouldn't have an impact unless, have you been applying for other credit cards or have you been applying for car loans? No. Okay, then there's nothing to worry about.
Yeah, and in most cases, a pull can be 5 points or 7 points at that. But you make one late credit card payment, that's 100.
Oh yeah.
Like, and your credit card minimum could be $40.
Exactly.
So you could mess up on a $40 minimum payment and lose 100 points like that versus a hard pull. I might be 3 points scared of it. It's not even.
Especially coming, you know, closer to ending a lease, and that's what this article talks about. Like, you're coming closer to ending a lease, and I'm talking about 4 or 5 months. It's good to be out there and start preparing. You know, prepare yourself already on some of the things. And when you go to apply for a home mortgage and they pull the credit, they can actually see a simulator there to help you increase those scores if needed. If nothing's needed, you got excellent credit scores, well, perfect.
This is the advantage of doing the rapid rescore, which you talked about last week. If you needed to, you can simulate and look at what are opportunities for you to get from, let's say, 679 to above 680, or from 720 to 740 or something like that. So, like, honestly, take this advice and like run to the bank. Take it to the bank. No, but seriously, do that. You can get your credit checked because it is part of your debt to income ratio, which is the other part of this, which is based on your credit, there are factors of whether your score or your interest rate is going to be higher or lower based on your credit worthiness. And your interest rate being higher or lower changes your debt to income ratio, which then determines how much you can afford to borrow from the bank.
That's right. I mean, we got to remember, lending is all about risk factors, right, Brian? And so one of the things we help our clients understand is like the article states here, understanding the status of your credit and your debt to income ratio is a good place to start. I agree 100%. There's no harm in checking your credit, right? I mean, the article states it here because it's 100% true.
Yeah.
For me, it's just like, you know, I like to go by the Nike slogan, right?
Just do it.
That's it. Just get it done.
I was hoping that's the one you were referring to.
Right. That's what I was referring to.
Can we talk about debt to income ratio a little bit? Because I know you guys both have that conversation a lot. Brian, I know I overhear you next to me. We're talking about debt to income ratio. Over here, you're talking about debt to ratio. I see you got a couple notes there.
No, it's too expensive. You can't.
What were you going to
Mira.
Wow.
Mira nomás.
What was it you looked like you were going to make a point about this part of the article?
So it said right here that, you know, you should go based off the 2836 rule, which, I mean, unless you're banking in a lot of money, that you could go off of that. And I just broke it down, you know, a little simple math. In California, the average salary is around $84,000, which breaks down to like easily $7,000 a month, and 28% of that is only $1,969. So you tell me where in California you're able to, you know,
utilize your 20%. Do your math again.
So
what'd you say the income was a month?
84,000.
Yeah, divided by 12.
Divided by 12 comes out to 7,000.
7,000, right?
So I use 7,000 times 28%.
1960.
That's it.
Got it.
Yeah.
So that's what this is referring to, which is
exactly.
It's not the norm.
Thank you for the math check.
Yeah, no. I thought I saw 1,060. I was like, that can't be right.
No,
I'm sorry. I didn't hear you say it right. So sorry.
There's no way we're going to find rental on that.
But either way, I know you checked it because it looked a little low.
Wait a minute. Hold on a second.
But my point is that, you know, it's really difficult to go based off these examples when, you know, in reality, that's not what's happening out there. Yeah. Then they can follow it up and say, well, on average, it's actually going to be around 50 to 55, 45. 55. That's a little bit more of, realistically what your debt to income ratio is actually, used when lenders are looking to approve you. So I think for me, the most important thing here is understanding that they go based off your minimal payments. So if you believe like, hey, I pay a lot in debts, or I'm just holding a lot of debt, they're not going to approve me, calculate your minimum payments and then divide that by your income. And that's going to let you know your true debt to income ratio that the lenders look at. And that's exactly how they'll calculate it.
Yeah.
There's something else too I want to make sure I bring up when it comes to debt to income ratio specifically. Is it's different based on the type of loan you're looking for? VA is a little bit different than FHA than conventional, right or wrong?
Correct.
Right. They're generally in the same ballpark.
So if we go with conventional go all the way up to 50%, 49.99. Okay.
Yeah.
Front end and back end. What that means is their current mortgage payment, no more than 49.99% of your income goes towards that, right? Yeah. The back end ratio, or your total housing ratio, no more than 49.99 of your income can go towards that, and that's including your credit card debt, your, that
taxes,
stuff.
Insurance, all that stuff. Yeah.
Well, no.
You mean including personal payments?
Personal tax, correct. Your car payments and all that stuff.
Yeah.
Please no, cell phone bills and all that stuff don't count. It's stuff that's just right on your credit.
On the credit report.
With FHA, it's 46.99 front end. Back end could go all the way to 55, 56.
Right. Depending on your credit compensating factors.
Exactly. And you have to have good credit. I mean, there's certain things. VA, we've seen it as high as 78.
Yes.
79. Yeah. Back end.
And that's because they use a different formula.
Yeah. Front end, I've seen, I think the highest, I'm going to probably exaggerating here maybe a little bit, but I've seen it to like 57, 58%.
Yeah, high 50s.
Yeah.
For sure.
And you got to have excellent credit. You have to have
minimal debts.
Money
in the bank.
Yes.
Yeah. Money in the bank.
And obviously good job working history. You don't want to have any gaps.
Exactly.
Like you literally just want to tee everything off, because then the bank will look at it like, okay, based on everything that we see, even after your mortgage payments, even after you make every payment, you still have X amount left over to be able to pay. I wish they would be able to do that for any other, type of loan, but unfortunately you can't go higher than your debt to income ratios on other loans, even if you have the compensating factors.
Yeah.
I only bring it up because I didn't want the conversation to get like locked in and cornered onto like, oh, this is just a hard and fast rule. It is the best rule when it comes to like how to maybe prepare or figure out without talking to someone like us, knowing where am I financially with my income compared to what I can afford every month. But when it comes to VA versus conventional FHA, they have different ratio thresholds. Number one. Number two, VA specifically uses a whole different formula for calculating the net residual monthly income. So after like all that stuff. So there's that part. The other thing too is remember that if you are paying child support and alimony, those are going to count. Student loan payments that are on your credit report, all that stuff. So if
if they're deferred, we have to.
If they're deferred, if you've co-signed for somebody else, like all that stuff's going to come to play. Yeah, so we're having that kind of this like nice little conversation about debt to income ratio, just about your credit. Yeah. But if you co-sign for people, child support and alimony,
that's on there.
That's all going to be in there. Did I forget something else, guys? Or those are the ones.
No, but one of the things I did want to say is that speaking with a mortgage professional can help you map it out, and I think it's very important that you do connect with somebody you trust, or somebody that you're able to ask those questions. I am very, very, very confident that everybody on social media follows a lender and a realtor that you can reach out to, ask these soft questions through a DM. Very, very easy to digest. You're not getting pushed into anything, but it's going to open up the door for you to start, oh, okay, I can do that, or based on my situation I can take that route. So I would say, even as dumb as you think the question is, shoot your DM, and you're going to find out that you're going to get the right answers. You're going to get pushed in a direction where it's going to bring you a lot more clarity, and it's going to give you more confidence if you want to pull the trigger or not.
Yeah. Hey, Brian, how funny was it when you saw that 28-36 rule? I mean, it's part of our test, right? Like, come on. What world are we in?
It's like twice.
I want to know what their income is. They probably have really high income.
Yeah. That's.
I'm like, no, we're here right now.
Like, that's a very, very, very conservative debt to income ratio.
Yeah.
Relative to what the products are in the market that offer. So,